Chapter 11 Summary. Bonds are a type of long-term debt usually sold by borrowing smaller amounts from more investors. Most bonds' face or maturity value is $1,000. The bonds will have a stated interest rate printed on the bond. This stated rate determines the amount of interest payments. The market rate on the date a bond is issued may differ from the bond's stated rate. If it does, the bond will sell for a value other than its maturity or face value. If the market rate is greater than the stated rate, the bond will issue at a price below maturity value or a discount. If the market rate is less than the stated rate, the bond will issue at a price above maturity value or a premium. Regardless of whether bonds are issued at a price other than face value, the cash paid semi-annually to bondholders is always the same amount because it is based on the interest rate stated on the face of the bond. When bonds are issued at a discount, the market interest rate is greater than the stated interest rate on the bonds, so interest expense is greater than the actual cash payments for interest. Whether bonds are issued at face value, discount, or premium, the bond maturity value is what the company must pay to the bondholders at the bond maturity date. Bond discount or premium is amortized using the straight line method or the effective interest method. Amortized discount increases interest expense. Amortized premium decreases interest expense. When bonds are issued between interest payment dates, interest is accrued. Current liabilities are those liabilities due in a year of the balance sheet date or the business operating cycle, whichever is longer. Long-term liabilities are those liabilities due over a year from the balance sheet date. Appendix 11A. We began in this chapter with straight line amortization to introduce the concept of amortizing bonds. A more precise way of amortizing bonds is used in practice and is called the effective interest method. Generally accepted accounting principles require that interest expense be measured using the effective interest method unless the straight line amounts are similar. In that case, either method is permitted. Total interest expense over the life of the bonds is the same under both methods. However, interest expense each year is different between the two methods. When retiring bonds before maturity, follow these steps. Record partial period amortization of discount or premium if the retirement date does not fall on an interest payment date. Write off the portion of discount or premium that relates to the bonds being retired. Credit a gain or debit a loss on retirement.